All right, stop me if you've heard this one before. I'm at a bar having a drink, and a guy standing next to me ordering a drink as well. Never met him before, strikes up a conversation, and eventually asks me, "What do you do for a living?" I say, "I own a mortgage broker business." And he says, "Oh, wow, what do you think about rates? And more importantly, what do you think about the upcoming market correction?" I said, "What market correction are you talking about?" And he said, "Have you been reading about Warren Buffett, who's now about $334 billion in cash, and he's just getting ready to pounce on the next big market correction." And that has been making the rounds on social media that Warren Buffett is in cash and he is waiting for some kind of market correction because that's what Warren Buffett does. But what does like someone like Grant Cardone or other experts say about this coming big market correction and what Warren Buffett is waiting for?
It's not single family homes. I'm not talking about single family homes. And the reason I'm not talking about single family homes in this equation is because 70% of all single family homes in America have a loan under 4%, less than 4%, less than 4%, every one of them. Okay, 30%, almost 30% of all the homes in America are paid for in cash. So you're not going to have a collapse in the single family. Where you're going to have a collapse and a correction is this $2.7 trillion worth of commercial debt. And I believe that's why Warren Buffett is dumping his Bank of America stock.
And I agree 100%. I bought a commercial building, moved my mortgage company into a spot in downtown Oviedo. And you should come out and check out some of the classes we're doing, whether you're a first-time home buyer or real estate agent. But the main point is that when I bought that building, like all commercial debt, it is on an adjustable rate, usually fixed for 3 or 5 years. And it was very difficult for me to find anybody that would give me a 5-year term on a commercial loan, which means that debt is constantly resetting. And it is something that is not fun about owning a commercial building. And what he's saying is true is that people bought when commercial buildings were 2 or 3% interest rates. And now that debt is resetting, say in 2025. Well, those people are going to be in trouble. They have to refinance that debt, and they're likely have to do a cash-in refinance, meaning when you look at the cap rate of commercial real estate, the payment that it's going to reset to, they're going to have to refinance at a lower loan balance, and that could, like Warren Buffett and some of these people are saying, create a commercial loan crisis and an opportunity, especially for the people that play in that space. As far as residential real estate, I couldn't agree more that right now, the winds are turning and we are starting to see a market shift, I believe, a little bit more in the right direction. Always going to get some hate when I say this, but to be clear, any market can correct, but you need enough inventory and things happening in the right direction to do that. So let's take a look at mortgage interest rates and what's likely to happen in the market. Hey everyone, this is Rayce Robinson, your favorite Florida mortgage broker, and the PCE came out, which is the Fed's favorite measure of inflation, and something I said last week could move the market positively depending on how it came out. And it came out really flat, really almost dead in line with expectations. So did we get any follow through or increase in rates? So we looking at this chart here, which tracks mortgage-backed securities. And this is a converse relationship. As this is going up, rates are getting better. And you can see we have been on a nice run really since February 12th. And we are flirting with this top level of resistance that every time we've hit it, let me back out a little bit here to a little longer term. And you can see every time that we've hit this ceiling here, we've had a rebound, right? And so we've been trading in this range for quite a while, and we will see if something changes. But in the short term, at least right now, we finally got 30-year fixed rate mortgages to that 6.75% range. And if we look here at the trend, again, really since that's February 11th or 12th here, where this really nice downward decrease in rates to the 6.75%. And we've hit this a couple times and shot back up. I've showed this before where really at the end of last year, like last quarter of last year, September, October, we were pricing in more rate cuts. And then that got stripped away by some inflation data, the CPI and PPI, and that has went back up. We had a good PCE come out, and we also have some data that says maybe we'll get lower rates throughout this year. And that's going to show what's going to happen in the market as far as inventory and all those other things. And look, inventory is going up. It is the softest market I've been in a long, long time, but not anything like 2008. Sellers are not massively lowering their prices, though they are doing more than I've ever seen in a long, long time. And if rates were to hit, let's say, that 6% range, mortgage applications are going to jump, and a lot of that stuff is going to get stripped out. Will we hit 6% by the end of the year? We will see. Right now, it's interesting to look at what the Fed is pricing in. So this is the Fed Watch tool looking at what the Fed's likely to do. So right now, in the next meeting in March, they're saying there's a 93. They're predicting a 93% chance that the Fed won't cut the Fed funds rate, which influences interest rates. If we go to the May meeting, it's about 68% of the people thinking the Fed won't cut. And if we go to June, now we look at more where the market is actually predicting a cut in interest rates. That's important because the market is already pricing in a rate cut, none at all March, and between basically March and the summer, call it June, to get one rate cut. That's already priced in. So if that happens and the Fed cuts the Fed funds rate this summer, you won't really see a big improvement in rates. It's more going to be what the Fed says after that. And I've said I thought rates would be just under 6.5 by the end of the year. And they will probably indicate what their strategy is going forward as far as more rate cuts. And based on that meeting is how interest rates will turn out. And we shall see. But I can tell you 100%, barring some black swan event, rates are getting lower. Now let's take a look at pending home sales, which went down 4.6 in January, which is obviously an indicator of sales that are going to be coming. If pending home sales are falling, that means that there's going to be less solds coming up in the next month. And there was a pullback of 4.6%. They actually say exactly why that might have happened. And I'll just read it. It's unclear if the coldest January in 25 years contributed to fewer buyers in the market, and if so, expect greater sales activity in upcoming months, said NAR chief economist Lawrence Yun. However, it is evident that the elevated home prices and higher mortgage rates strained affordability. Housing affordability suffered in January as mortgage rates ranged from 6.91% to 7.04%, which we just looked at rates. And compared to a year ago, the monthly mortgage payment on a $300,000 home increased by an extra $50 to $1,590 a month. And then they just kind of do the snapshot, which shows you that in the South, month over month, we had the biggest decline at 9.2%, where in the Northeast, it actually went up, Midwest down 2%, and in the West down 1.2%. So the South, especially here in Florida, making a big part of that decline. And that's no surprise, because if you take that, what the chief economist said of NAR, and add in Florida, rising insurance rates, also hurricanes and storms, and also pulling in certain areas like Punta Gorda and areas that have been affected by the storm, those are really dragging sales down. And if you're a buyer watching this, don't get caught up in that, because if you're in a different market in Florida, that market is going to behave differently. And look, I definitely understand affordability is not what it was. I thought this was an interesting article where they said the income need to purchase a typical U.S. home has increased 79% in just the last 5 years. And in 2020, you needed $51,646 for a median home price. And in January of 2025, you needed $92,538 to buy a median priced home, which means affordability stinks. And until rates fall meaningfully, you're not going to release that locked in inventory, and you're not going to get a huge amount of buyer demand come back. The prediction right now is about 4.2 to 4.4 or so million transactions in 2025. We shall see. So if you're a real estate agent and you're wondering what can you do, I'm going to put a link to some classes we're doing on all the first-time home buyer programs, the grants, the assistance, because right now we want to help buyers get a leg up, especially when sellers are willing to help. And more importantly, as more information becomes available, as always, I'm going to cover right here. Have a great day, great week, and I'll talk to you soon.